This is not my usual content, but I have to tell a story. And I have a feeling that this is going to be really wild and really helpful and beneficial for everyone. So I'm just hitting record and we're going to figure this out together. So, just to give a little bit of context, my family just bought a house. So we closed on our primary residence in Austin, Texas on June 27th. I'm recording this now in early September. So if you've ever bought a house before, you know that you don't usually make a mortgage payment the first month because like it takes time for them to get your account all set up and everything. So usually built into your closing costs is kind of like your first mortgage payment. So in essence, you like skip a month, right? And we did this like unconventional style of buying our home, which is actually the whole point of this video. So I'm going to share more about that in a minute. But we did this unconventional style, and they said, hey, it actually might take up to 60 days before you get your account and you can start making payments. So we got our account, I want to say in mid August. So it wasn't quite 60 days, but we bought June 27th. So we didn't make any payment in July, didn't even have an account set up to make a payment. And then by mid August, we got access to our account. And now I'm recording this in the beginning of September. So I think we've had access to this account for, let's call it 3 weeks, not even quite a month yet. And I was just curious because I wanted to see if this crazy way that we bought this house is actually working out the way that I hoped it would. And so I wanted to compare what my mortgage balance would be right now, only 3 weeks into having it, if I had gone a traditional 30-year fixed rate mortgage, which PS, I've bought houses before and I've always bought with traditional fixed rate mortgages. That's what I was told was the best. You don't want a variable interest rate. You want your interest rate locked in. You want it to be as low as possible. And then you pay it over the course of 30 years, right? And so, all of my friends who owned houses during that post-pandemic boom all refinanced into these like really sexy low interest rates. Like I have a friend whose rate is like 1.9%, which is just like unheard of, crazy low rate. I have a lot of friends who have interest rates in like around the 2%. And of course, we just bought mid 2025, and so interest rates were like hovering right around 6%. Nowhere near as good. But then we bought using this totally different method. And so we have a variable interest rate. It's even higher than the 6%. But it's supposed to help us pay off our home crazy fast. And I just wanted to see if that is actually true. By the way, if we've never met before, I'm Emily June Wilcox, and I am a money and business coach. So I typically help myself and my clients work on their money mindset, specifically healing the 6 core money wounds that block us from wealth so that they can utilize any strategy they want to grow their income and build wealth and do it in a sustainable way and in a way that actually feels good to their nervous system. So that's kind of my context. I don't believe that there's any one path to wealth. And although I'm a money coach, I come at it from an energetic perspective, not from a strategic perspective. And then I do a lot of business coaching. So I help a lot of entrepreneurs to scale to their first 7-figure year in their business and that kind of thing. So that is a little bit more strategic and tactical, but it's focused on specific things within the business, not necessarily so much about personal wealth and personal net worth. Although of course, as your business makes more money, you make more money, you build net worth. So it's all connected. But I'm always interested in this topic for myself and wanting to continue to build more net worth and of course want to share new things that I find. So, all right, we're just going to screen share here. And here's what we're going to do. We're going to pull up an amortization calculator. So if you don't know what amortization is, it basically takes a loan and all of the details of the loan and then shows you what your schedule would be, how much you'd pay in interest and principal. All right. So we started out with a loan of $560,000 for our house, 30 years. Now, our interest rate, like I said, we have a variable interest rate and it's higher than what the going rate is. But I want to compare it to what a traditional mortgage would be. So I think I was getting quoted around 5.9%. So I just want to check and see. I'm going to switch this to monthly. And essentially, we've had our mortgage account available for 1 month, right? So if we had gone the traditional route and gotten a 30-year fixed rate mortgage, so far we would have made one payment. And of that payment, $2,753.33 would be interest. $568.23 would be principal. Usually, then you're also paying like your property taxes and your homeowner's insurance get wrapped up in there too. But obviously, that's not doing anything to affect how much you actually owe on the house, right? So then our ending balance would have been $559,431.77. Pretty typical. Because, like I said, I've only ever bought houses this way until this time. And our last house that we owned, we actually made a lot of money on it, but we made all of our money pretty much on the appreciation. I was kind of surprised because we were in that house for 5 years. And I think maybe we had paid off like $20,000 or $30,000 in principal. It wasn't a whole lot. Let's look and just see in this scenario, like after end of year 5, we would have paid off a roughly almost $40,000 in principal. So yeah, that's about right. I think we only paid off like 30,000 in principal, but also, it was a different house, different purchase price and all that kind of stuff. So, okay, you guys, this is wild. I don't want to show like my actual bank account because I don't know if there's like sensitive information there. But right now, my balance on my mortgage, the principal is $530,000. 3 weeks in. 3 weeks in. So let's look and see how long it would have taken me to get to that ending balance. So more than a year, more than 2 years, more than 3 years. Oh my God. Oh my gosh. This is insane. I'm actually seeing this for the first time. So it would have taken us 47 months, which is almost to the end of year 4. 4 years to get to the mortgage balance that we are at right now, 3 weeks in with this different system. This is insane. This is like absolutely bonkers. We did in 3 weeks what it would have taken us 4 years. And the crazy part is that based on my calculations, we're going to have our entire house paid off in under 4 years. And I'm sure everyone is thinking like, well, you must be making extra payments. And the answer is sort of yes and no. We kind of are making extra payments, but not in the way that you would expect. So let me see. I'm just doing this on the fly here. So I'm going to see if I can like draw without having it be a total nightmare because I don't have my little Apple Pen thing. Okay, I'm sharing my whole screen. All right, so you should be able to see this. And let's just see if we can draw without having it look like a colossal failure. Maybe we'll use some shapes to help us, right? Okay, so normally that would be like my pool of money, personal money. And then over here would be my mortgage. So these are like personal funds. Can I copy that? No. Okay. And then this would be mortgage. Sorry, guys, I'm like learning how to use this while I'm going. Okay. So the way that I've always done it before is that the money only goes in this direction, right? And so there are like all of these strategies where if you make bi-weekly mortgage payments instead of monthly, you pay your home off, like X amount faster. Um, Obviously, like if you were to do a 15-year mortgage, right? Your payment is higher, but you pay it off faster. Um, you could pay like an extra $200 of principal each time, each payment, and you'll pay your home off faster. So I knew about all of these things, and I've even done some of them myself. And my parents even modeled that for me. Like they were able to pay off their home, I think maybe like in 20 years, and even though it was a 30-year mortgage, because they were throwing like an extra chunk at the principal. Um, so all of these are good, but they don't really change the fact that you're paying tons and tons of front-loaded interest. Because, like, going back to this amortization schedule, the way that home loans and auto loans are done is that all of the interest is front-loaded, right? So you can see if you just watch this interest payment, you see that the interest is going down, 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 down over time. And if we just keep scrolling, oh my God, this like takes forever to pay off a house. Whoops. Where did it go? Here we go. I mean, we're 23 years in right now. And instead of it, it's like now it's down under 1,000. And so the interest just keeps going down, 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 down. So that like your final payments are just the teeniest bit interest and mostly principal. But they start out all interest and almost no principal, right? I guess you can kind of see it here, right? The interest is in green. Um, well, that's weird because it makes it look like the opposite of what it is. But anyway, um, so if you pay a little extra on your principal, you will knock it down faster, but you're still paying like the vast majority interest. And then the other thing that I don't love about these strategies, I think they're better than nothing, is that you're still not going to pay it off that fast, and you have more money that gets locked up because this arrow only goes in one direction. It's like if I were to make an extra payment towards my mortgage and then I had an unexpected expense come up, well, too bad. Like I can't get that money back. So you have to be pretty conservative about how much money you throw at your mortgage because once it's there, right? So the thing that we did, thank God for YouTube, you guys, because YouTube was how I discovered this strategy. And then I was brave enough to actually implement it, which is the other piece, because when we're going against conventional wisdom, it can feel really scary, especially when we have unhealed money wounds, especially as women or especially as minorities, because we've also been conditioned to not trust ourselves, that we are not trustworthy with money. I mean, women, it's only been like 50 years since women could get a bank account, get a credit card without having a man sign on it. So it's like we've been conditioned by society to be told, like, you can't be trusted with money. Whoa, whoa, whoa. Like, we need somebody else on board. Right. And so then not only do you have to trust yourself, but when you're doing something unconventional, like you really have to have your own back, because um it feels scary, like it feels scary to go against conventional wisdom. And you'll have a lot of people who are in the financial industry, even, they seem like the experts and they're telling you like, oh no, don't do that, or oh, I've never even heard of that. I mean, I was educating mortgage loan officers. I had loan officers telling me like, no, you can't do that kind of loan. I'm like, yes, you can. And it's like most people don't know about this, even in the industry. So I have done a ton of work on my money trust wound. And so I really trust myself and I have my own back a lot. That doesn't mean that I don't ever question it, right? That's why I wanted to look and see like where are we at with things, because um, it's one thing to do it and then it's another thing to actually see the result of it, right? Okay. So what we did is we got a special kind of loan. This is the weirdest looking double arrow I've ever seen. Okay, that is slightly better. We got a special kind of mortgage that allows the money to flow back and forth. So because of that, again, when you're like, okay, Emily, are you making a ton of extra payments? Like, how did you go from $560,000 owed to $530,000 owed in 3 weeks? Like, clearly you had to throw a bunch of extra money at it. And like the answer is yes, I did. But the reason I could do that, so for using my numbers as an example, the only reason I could do that is because this arrow goes both ways. Because I did have 30K available, but that 30K is our emergency fund. Some of that money is money that I'm going to be using for some other like potential real estate investments. Um, there's other stuff that money is kind of earmarked for potentially. Now, if you've ever had a rainy day fund, you know that sometimes it just sits there for a long time. And like, thank goddess for that. I don't want like some crazy expense to come up. Um, Now, by the way, this, well, okay, I was about to say that the strategy is only good if you make more money than you spend every month. And that is true in the sense of paying off your mortgage faster. But if you have a lot of debt, you can still use this strategy to eliminate debt a lot faster, which then frees up cash flow. And then once cash flow is freed up, then you will be cash flow positive and then you'll pay off your mortgage faster. So it still mostly works either way. Okay. So because we are cash flow positive every month, we have funds that we don't always even need to touch, reserves, savings, emergency funds, that kind of thing. And so in this scenario, I can throw all of that at my mortgage. And then you might be saying like, okay, well, why would you want to do that if you might have to take it back out? So the kind of mortgage that we have is called a first position HELOC, or sometimes called an all-in-one loan. If these weren't already unconventional enough, Texas has all kinds of extra rules around home equity lines of credit, which is what a HELOC stands for. And so they're even harder to come by here. They're even more rare. So I like really had to go for it. Um, what was I saying about this? Oh, okay. So this kind of loan, um, it operates in a totally different way. So it is not amortized interest. It's simple interest. That is hugely important because remember, the amortized interest, I can't really get around paying tons and tons of interest because they front load all of the interest. Whereas I'm just doing this on the fly, so we're going to see how this goes here. I think my interest rate is like 8%. So in theory, again, going against conventional wisdom, which is a better mortgage, 5.9% or 8%? Everybody, I could pull 100 people on the street and everyone would say that the 5.9% is better. But this 5.9% is amortized and the 8% is simple interest. So it works the exact opposite. You start just paying principal. And then over time, you would end up paying more interest if you have to pay this whole term, right? So, but because we're paying down the principal, we're never even going to end up paying anywhere close to that much interest because the principal's all front loaded. So the other thing that happens in this kind of a loan, oh, darn it. Edit, undo. Okay, let's just add another text box. Is that the interest is calculated daily based on the actual balance. So if I just use this as a parking lot for all of my cash that I don't need right now, that I might need later, then my interest is being calculated on a smaller amount than instead of it being calculated on the 560, which is where it started, it's being calculated on the 530. And that keeps compounding over time because we're cash flow positive. We just let all of our money sit in here. We pull it back over to the personal side when it's needed. And when you do this, it's absolutely insane. You don't have to change your personal spending behavior at all in the sense of I don't have to budget. I don't have to decrease my expenses. I don't have to go on fewer vacations. I don't have to make extra mortgage payments. None of that. All I do is I let all my money sit in here until there's a bill that has to be paid. And just by doing that, because of how much money we make and how much we spend every month, oops, that's not what I wanted to do. We will pay off our home in 3.5 years. Absolutely bonkers. What gets me even more excited, just from like a net worth perspective, is that once the home is quote unquote paid off, I still have access to 560K that I can use to invest. So there's no reason to just have my home paid off and then not do anything with it. As I'm paying it off, or when it's paid off, I can invest. I could buy an Airbnb property and now use the money that's coming from the Airbnb to be paying off this line. Now, instead of the Airbnb being on a 30-year amortized interest schedule, the Airbnb is going to get paid off in 3.5 years. Maybe it's even less because maybe the Airbnb doesn't cost as much as our primary residence, and now we pay it off in 2 years. Not to mention the fact that I didn't have to go get another loan, which has at least 10 grand worth of closing costs in it. I became my own bank. So this becomes my own bank where I can make deposits and I can make withdrawals. And I am just like over the moon excited about the wealth building opportunities that this presents. Now, we're also doing like some next level ninja shit to multiply wealth even faster. But like, even if all we were doing was this and nothing else, to me, like, my mind is absolutely blown that in 3 weeks, we've been able to accomplish what it would have taken us 4 years to accomplish with a traditional mortgage. Even though in theory our interest rate is higher. It's so weird, you guys. I'm only 3 weeks in, and already I don't feel like I have a mortgage payment. I literally don't. I I'm gonna stop screen sharing here because I just want you to see my face and hear this. I feel like I've escaped the matrix, honestly. If you're someone who believes that a lot of the financial systems are set up to keep us trapped, to keep us as like little worker bees that are working during all of the best years of our lives, to then hopefully have enough money saved to be able to retire and enjoy a few years before that money starts being used for long-term care, hospice, etc. Like if you're someone who just knows that there has to be a better way and you've been wondering what that better way is. And here's the thing. I think we all understand that the top 0.1% operate by totally different rules, right? Like they're probably very rarely getting a 30-year mortgage on a home. We already know just from like the United States presidents who disclose their tax returns that they're not paying the same tax rates that most people in the United States are. Why? Well, because there are legal tax loopholes based on how your money comes in and what sort of write-offs and offsets you get. You may not pay any taxes at all, or you might pay a way lower rate, right? We already know that that's true. We know that the top 0.1% in the United States are doing that, that they're leveraging all of these kinds of things. And sometimes it just feels inaccessible if we're not at that level yet. And I'm so excited about this strategy because I'm like totally escaping the matrix. I'm like unsubscribing from one huge piece of the financial system that, by the way, gets sold to us as the American dream, right? Owning your own home gets sold to you as the American dream. But if you've owned a home, it's not always so dreamy. Now, I've made good money, like owning homes and then selling them later for profits and stuff. So, there's lots of different ways to do it and have it work out successfully. Um, but having 30 years of debt attached to that home is not so exciting. Especially now I'm 41. The idea of 30 years, like probably I'll still be working in 30 years because I'm an entrepreneur and there's things that I love and there's things that I enjoy, but maybe not. Maybe I will just be generating passive income or whatever. But like the idea of having to make a payment and being obligated to that for 30 years, I'm like, no, not interested. 3.5 years without changing my lifestyle to then have an asset that becomes a bank that helps me to build wealth and acquire other assets. That is super interesting. That is super interesting to me. And it's the theory of it got me so excited that we got the house this way. And honestly, like getting that loan was such a manifestation too, because as an entrepreneur, um, just getting a mortgage, it's like such a different process, the way they look at your finances and everything. And, I had a few different mortgage brokers that were like, we don't know, we're not sure. And I'm like, what are you talking about? Like, the house that we want to buy costs half of what we've been paying in Southern California. Half. Like, we can afford this in our sleep. And they were still just kind of like, And it was all just meant to be because the loan that I really wanted was this special kind of loan. And I ended up working with the most magical, wonderful loan officer, and he made it happen. And honestly, like my jaw is on the floor. My jaw is on the floor that we're 3 weeks in and we've accomplished what it would have taken 4 years of monthly payments to accomplish. So there's no sales pitch here. This is just like a public service announcement. I guess my only sales pitch would be heal your money wounds. Work on your own internal thoughts and feelings, your own belief that you deserve wealth, your trust in yourself, that you can make good financial decisions, that you are a good steward of wealth. Um, Work on healing those money wounds because I can't imagine myself making these kinds of financial moves if I had the nervous system around money that I had even 5 years ago. So if this is the first time you're hearing anything about that, I'll drop a couple things in the description. Number one will be a free quiz that you can take that tells you what your top money wound is and gives you some resources to start healing it. And then number two, I've written a book called Wounds to Wealth that is all about diagnosing and healing your money wounds so that you can welcome in more wealth. So I'll drop a link to that below as well. Um, but even if you don't do either of those things, just knowing that there are ways to escape the financial matrix and build wealth exponentially, that these things exist, that they're legal, that they're not a scam, and that they work is so important. It's remarkable, really. And if someone hadn't made a YouTube video that I watched, I wouldn't have known it existed. So that's why I wanted to make this video today, so that I can be a part of this change that I wish to see in the world. So thank you so much for tuning in. If you have questions, if you want to hear more about this, please leave a comment so that I can get that feedback and I can prioritize making more of this kinds of content. And I can also address anything that I missed. I'm new to talking about this, so I may have like missed some important details that you need in order to connect the dots. So definitely throw any questions that you have in the comments, any requests for more information, and I'll be paying close attention to that. All right, thanks so much for tuning in.